Hello friends, my name is Namasu. Today we shall discuss about a topic, the net present value. And today's topic is very interesting and very important with respect to project management or project selection methodology or business point of view. This is a very important topic, especially if you are a student of let's suppose for example PMP, project management professional, or a business management point of view. If you are a student, so this is a important topic and you will see this topic especially in the exam as well. Or you are a professional working in any organization as a professional, so again this topic is necessary for you to understand. So let's just start, friend. First of all, I would request to please subscribe to my YouTube channel and click on the bell option as well, so that my new videos can reach to you. So let's just start. Net present value. Friend, net present value is a methodology, is a approach through which we can judge the current value of a project actually. Then basically what happened that whenever we are initiating any project in an organization, we have to judge basically that whether we have to start a project or not. Actually, net present value is a methodology for a project selection actually. Project selection means that it is a criteria which give you the worth of a project, a value of a project, whether this is worthful, valuable for you as an organization to start a project or not. What is the current value of a project, what is the current worth of a project, so that we can take a decision as an organization that whether it is worthful to start a project or not. So net present value, with respect to project management point of view, it is a project selection methodology which we use to understand, which we use to calculate the net present value, which the current worth of a project, so that we can judge, we can take a decision whether we have to start a project or not. So net present value, short form is NPV, is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is used in capital budgeting and investment planning, as well as in project management as well, to analyze the profitability of a projected investment or project. So basically that means whenever we are investing in a project, for example, you are investing $5,000. So by using the formulas of net present value, you can calculate that what is the worth of a project, what is the profitability in a project, so that we can take a decision whether we have to start a project. Start a project means basically, what does it mean? Basically, whether you have to invest in that project as well. Because see friend, every investor, like any investor, they want the profitability, they want invest a return. They want to know that if they invest some amount, how much they will get back. Okay, so this is very important to know that what is the profitability in a project, in an investment in a project, so how much they will get back in return. So net present value or NPV is used to calculate the current total and value of a future stream of payments. Okay, if the NPV of a project or investment is positive, it means that the discounted present value of all future cash flows related to the project or investment will be positive and therefore attractive. To calculate NPV, you need to estimate the future cash flows for each period and determine the correct discount rate. Basically friend, it is just a mathematical formula. By using the cash flows and the discount rate, we basically calculate the net present value. Okay, and that present value shows you that how much, what is the net present value or the current worth of a project, so that you can take a decision as an investor, as a business person, that whether as an organization you have to invest in a project or not. Because after using the formula, you can calculate, you will know that what is the profitability of that project. Now the formula of NPV or net present value is NPV XYZ is equal to Z1 upon 1 plus R plus Z2 upon 1 plus R2 square minus X0. Now what is this concept here? Z is equal to cash flow in time 1, Z2 is the cash flow in time 2, R is the discount rate, X0 is the cash outflow in time 0, the purchase price divided by initial investment. First of all, friend, let me tell you that if you are a person, for example, you are planning for project management professional PMP, or you have to calculate the NPV. Remember, friend, that it is just a formula. You can use the Excel as well to calculate the net present value if you know all those values. Okay, so you can use the net present value as well. And with respect to exam point of view, let me tell you, if with respect to exam point of view, if you are a student of PMP, or especially if you are a student of PMP exam, or a Prince 2 exam, so remember that you don't need to memorize that formula, because in the with respect to exam point of view, they will, in the exam, they will never ask you to calculate the NPV, because to calculate the NPV, you can use Microsoft Excel and other tools as well. You just need to understand the concept with respect to PMP or another exam point of view, because they will only judge your concept, that you know the concept of NPV, net present value, or not. Okay, so just try to understand the formula, but you don't need to memorize it, because there are so many tools now nowadays available, like Microsoft Excel and other tools, through which you can calculate the NPV, or net present value. Now the what is the uses of the net present value? Right, present value is used to help to determine how much an investment project or any series of cash flows is worthful or not. It is all encompassing metric, as it takes into account all revenues, expenses and capital cost associated with an investment in its free cash flow of a FCF. In addition to factoring all revenues and costs, it also takes into account the timing of each cash flow that can result in a large impact on the present value of an investment. For example, it's better to see cash inflows sooner and cash outflows later compared to the opposite. Basically, friend, the main objective or main use of NPV is that it gives you insight, basically, that how much the is the worth of a project to invest. Okay, like if you are investing $5,000 in any project, so what is the worth of a project, by calculating the cash flows, so that you will know that whether it is worthful to invest in a project or not. So this is the main use of NPV, actually, or net present value, actually. The drawbacks of net present value: a long list of assumptions has to be made, sensitive to small changes in assumptions and drivers, easily manipulated to produce the desired output, may not capture second and third order benefits impacts, assumes a constant discount rate over time, accurate risk adjustment is challenging to perform. Basically, friend, whether there are some positivity, there are some advantages of using the net present value. However, there are some drawbacks and issues as well in the drawbacks. First of all, the major issue is the there we are using the fixed rate, actually, which is obviously not possible, which can be changed. So friend, thanks a lot for watching the video. I hope you like this video. If like, please share it with your friends and colleagues, and thanks for watching the video. Thank you.